it that you guys always attend these events with us, so we do appreciate it. As we kind of get started today, we have a really unique topic. I know a lot of times we bring in different people to talk about different areas in real estate, such as today's going to be multifamily. But our speaker today is actually one of the, I'm going to say, higher end individuals that we really do bring in. Now, before we dive into that topic, I always like to talk a little bit about Quest and kind of what's going on and what's coming up right around the corner. So once again, guys, I do appreciate everyone here joining our self-directed IRA weekly webinar. Make sure you leverage the chat box, leverage the Q&A box. We have moderators on here that's strictly going to be answering your questions as we go through these motions. In addition, in the chat box, you can pitch your own investments. All right, a lot of people don't use this like they should. Feel free to introduce yourself, exchange information, right? And as people keep coming in and joining us, feel free to repost your info. I promise it won't bug us. If you have great questions for myself or the speakers and how it relates to self-directed IRAs, please let me know. I always like to remind people that in the evening, we have some great events that always come up. We have a $1 trillion mixer going on tonight with a close friend of ours by the name of Kristen Gerst. Now, Kristen Gerst is a note expert, but tonight she's talking about one type of note, and that's going to be mortgage notes. A, how to create them. B, how to find them and buy them. So if you guys would like to attend this tonight's $1 trillion mixer, please make sure you do. It starts at 6:30 p.m. Central Time. Sarah is one of our moderators today. She'll give you the link right down below to help, sign up for this. Now, as we come to this month's end, right, we are giving you a free $125 for any brand new Quest clients that are signing up and setting up an account right now. So at the end of this presentation, if you're really interested in doing something multifamily related and you want to set up an IRA and go through the motions of investing in something along these lines, let us know. Send us an email. Let us set you up an account, and we'll even give you a free $125 to do so. So you only have about, 4 days left to take advantage of this unique promo. I know next month our marketing team is working on something really fun and unique to bring about. So guys, make sure if you're interested in anything as far as working with myself, working with one of our senior IRA specialists, reach out to us. This email does come to about 15 of us. All of us will respond, whether it's even from our cell phones or call you directly. So please reach out to us at any point in time. Now, boop, that should work out there. I just stopped sharing the screen. Sarah, as I was going through that, I hope you could see my screen. I just realized there's a little thing that seemed to pop up. Are these replays available on the mixers? Absolutely. So Kevin just asked, every time we do one of these events, guys, we do record it. We post it on YouTube for you to go back and rewatch. We do ask if you do watch them on YouTube, like our videos, give us a little subscribe. It does help us promote more and more things. And if you guys have unique topics you want to hear, send me an email to iraspecialist@questtrust.com, and we can go ahead and maybe even find a good speaker to talk about those areas. So now that I'm kind of done with the announcements, I want to talk briefly about our up-and-coming speaker we have for today's event. The first time I brought him on, and Quest, we brought him in, he came in and he drew a really large crowd. It was about 150 people showed up. And it was funny because he came in and he's a very personal guy, right? He's the guy that most people like to get to know because he works with you on a personal level. So when you throw him in front of a room of a bunch of people, he was like, oh, there's a lot of individuals here. And so what I like about him is the way he presents his information, the education aspect of how he provides it, and how easy he is to work with. So Paul, are you with me today? Oh, I saw him for a minute. Paul, I think your camera got shut back off. Can you see me?
Yes, I'm here.
Ah, love it. So Paul, I know today you're going to be talking about some multifamily aspects, right? But I'm going to leave the floor to you. I'm still here in the background. I may pause and ask some questions. And guys out there, if you're listening, ask Paul questions. Me and him will do a small Q&A at the end where you can get everything answered. So Paul, the floor is yours.
Thanks, Derek. And thank you to the team at Quest. And I want to say thank you to each and every one of you that joined us today. I know that we're all busy. You guys have busy lives going on. And for you to take an hour out of your life to share with us and be with us, be with me today means a lot to me. and I want to, try to add a lot of value. Derek, I don't think you're muted. I don't know if you want to mute yourself. Hopefully I can add a lot of value to you and make this time we have together worth your while. Thanks for joining us today. I'm Paul Williams with Multifamily Geeks, and I'm a partner and a visionary there for Multifamily Geeks. I want to talk about having multifamily in your portfolio and how you can use a team to team up in multifamily and do more deals faster with better returns. I want to give you a disclaimer. I'm not an accountant. I'm not a lawyer. This is not legal or tax advice. If you should go check with your accountant or a lawyer to, see what applies to you and get advice from them. So this is just information, not advice. Okay, so I know you guys attend a lot of these, and a lot of you are on here week after week. And so I don't want to just give you the same, and I'm not to knock anybody else's, because I think brings in the highest quality people to speak. Seems like they're always interesting, engaging, have a lot of good topic and some interesting things to think about. But I kind of wanted to give you not just my push for why you should invest in multifamily, but kind of give you, I don't know, I guess a different perspective, a different idea, not just hit you with multifamily, just, kind of think about some different things in the market as a whole, your portfolio, maybe your goals, and all that. So if it seems like I'm going sideways, then just bear with me. We'll bring it back around. And, hopefully you guys will have some questions at the end. You can put them in the chat box or, whatever. And Derek will help me to get those all answered. Okay. So having said that, let's see if I can play this thing here. Okay. So Ray Dalio, manager and I think founder of Bridgewater Associates, $48.5 billion fund manager, recently said, and has said a number of times, that cash is trash. He says cash looks like a low risk thing to hold, but really it isn't. And I believe there's a number of different people who have said the same thing. Grant Cardone, I think Jamie Dimon, Warren Buffett, just different people have said that or something like it. And, we all think of, where's the safest place to keep your money? Well, it's in the bank. But, really, is it? If inflation is at 2% and you're losing 2% of your buying power each year, then you can see that over time, over 10 years, you've lost 20% of your buying power. Now, I don't know where you live and kind of the prices of things where you're at, because we've got people all over the place, but I haven't seen 2% increases in the price of things. For me, I've seen 5%, 10%, 20%. And so if you're losing, let's say you're losing 10% of your buying power each year, then you're losing a lot of money just having it sit in cash. Jamie Dimon, a longtime CEO, Chase Bank since 2005, and he's the current CEO. He said, I wouldn't touch a 10-year treasury with a 10-foot pole, kind of echoing, that cash is kind of a dangerous place for your money right now. Ironically, savings rates have been higher than they've been in a very, very long time. 13.6% right now. I think it may be up at 13.8 this week or so. Last year's up to in the 30%, highest it's been since in the times of the Great Depression. So, and I think a lot of people are just getting nervous. We don't know what's going on with the market. Is it time to buy? Is it time to sell? Is it time to, so I think a lot of people step back and just say, well, let me wait, see what happens. And then when I start to see things moving up and moving in the right directions, I'll jump in again. And a lot of those people have missed some fantastic opportunities over the last year. And at the same time, they've been missing opportunities. They've also been losing buying power with their, with their money, because it's just sitting in cash. They're sitting on the sidelines. So, when we think about inflation and the cost of goods rising, and that our dollar is buying less and less each year, maybe somebody's like, well, I mean, isn't there a good time to hold on to cash? And I'm not saying you need to invest every dollar, because I think we all need a bit of a cushion. But if you're sitting on the majority of it and you're losing a lot of buying power, it's not growing. You're not investing in things that are keeping up with, or like a hedge against inflation, then it could be a big loss to you. So, has there been a negative inflation? Is there a time when it's been better to sit on the money while you're waiting to see what happens? Well, the negative inflation was in 2009, and just to kind of put this in perspective, the government, I don't know where they get their data from, but they estimate that we're having about 2% inflation. Now, I think they leave out non-essential things like electricity, heating fuel, price of houses, things like that, which I would think they're essential. But so in 2009, we had negative inflation. So the government leaves all that out, and then they say, well, the inflation is really only 2% when you leave out the non-essential things. But they say we've had negative inflation in 2009 was the last time. It was very small, 0.36% in the negative. The time before that it was negative was back in 1955. So, we're talking a long time that it's, that a long time between the times when we have negative inflation. So, and I don't want you to get too engrossed in this chart, but, as we look at this and see what our dollar bias, and it goes down and down and down each year. Last year, the U.S. money supply grew by 3.8 trillion in 2020, equal to 20% of the dollars ever created. And we look back in, 2008, when I think the supply was at $800 billion, and then that's grown and just ballooned. And, I think this year we're scheduled to print a lot more than we even did last year. So as money is printed and the value is diluted, your money is it's not shrinking, but it's buying less. And we heard back many years ago that have a 401k, and by the time you retire and you've got $400,000 in your retirement account, you will be set. And if you think about how long your lifestyle and how long $400,000 would last, most of us would want to have a lot more than that in our retirement to live off of. You're going to be spending more because you got more time off, and you're going to want to travel and do the things you've always wanted done. So anyway, so that's just kind of an idea where we are with the dollar, why sitting on the sidelines is kind of a dangerous thing. Now, one of the things that I just hate hearing, and we've all heard it so much, you probably heard it too a lot over the last year, is that we are living in unprecedented times. And I don't know if you're sick of hearing that too, but I am. And so I won't say it. But we do have some interesting things brewing. We've got money printing here, but it's not just happening in the US. All over the world, governments are printing more and more of their money, which really, wreaks havoc on the people that are saving it. Okay, so that's one big deal. The money printing, the devaluing of the dollar. Then secondly, we have the possible capital gains tax increase that's, that they're discussing taking it from 20% or 23% to 43.4%. And we don't know where that's going to go, but, there's already start to become, quite a sell-off in the in the stock market and in like the cryptocurrencies, because people are afraid of what's going to happen. Now, if that is passed, we could see a lot more sell-off and a huge drop in, or correction in those markets. So that's kind of an interesting thing that's happening that gives us some uncertainty. But then there's also the Great Southern Migration, people moving, and not just to the south, but people moving out of colder climates, moving south to warmer climates. People moving out of high regulation, high tax states to low regulation, lower regulation, lower tax states. And so we've got some really interesting things just going on here, just kind of in brewing. And so as we think about, okay, we're in crazy times, which I guess we could probably say that just about of any time. It's just always seems kind of crazy, but how do we find the ideal investment? If we can't keep it in cash, where do you have the ideal investment? Where do you have something that's going to hedge against inflation, that's going to grow, something that's going to be stable, not too volatile, something that's going to, maybe pay you cash that's important to you, something that's going to, be safe. And here's a few things that I thought of. What would the ideal investment look like? And I just kind of went through this. I'm like, well, and I listed these things down. Hedge against inflation, something that has tax benefits for owning and investing in that, something that has cash flow for the people that, that's important to them, something that's stable, not going to just fluctuate all over the place and, maybe lose all of it, which, by the way, I'll just throw this out here, that, there's risk in any investment, whether that's multifamily, real estate, or anything else. There's risk involved of, losing some or all of your money in just about any time of investment. So the ideal investment, what I came up with are these: hedge against inflation, tax benefits, cash flow, stability, something that's passive. We're all busy, right? I mean, a lot of you are maybe eating a sandwich right now as we go over this. Or, you're on a break, or, you're just, between meetings or whatever it is. But we want something a lot of people want something that's passive. They don't have to babysit and, do a lot of learning and spend a few hours a day or a week or a month to work on. We want something that's competitive, has competitive returns. Most people aren't looking for, 2% return or 3% or something just to keep up with inflation. The ideal investment, I think, would also have an asymmetric risk reward benefit, something that's high reward potential, but low risk potential. And we've all heard that, here's an investment. It's high reward potential, and there's a high amount of risk associated with it. Or you can pick this low risk opportunity, also has a low reward. Well, I think the ideal investment would have a high reward with a low risk, right? And then I guess lastly, on an ideal investment, it would be something that does okay in a downturn or an expansion. I don't want something that's going to do great in an expansion, and then there's a good likelihood I'm going to lose it all in a downturn. And then there are some assets that will do well in a downturn, but do poorly in an expansion, time of expansion. So, as we think of different asset classes, what can we invest in? Where can I allocate, some funds for, whether it's for, our kids' education or for our retirement, or, really living the lifestyle we want to live? What kind of asset does any kind of asset kind of meet these qualifications? So there's kind of 4 asset classes, and if you want to get really technical, there's 7. And I don't think anybody wants to spend the next 12 hours going over all the nuances and all the different ways. So in kind of a brief summary, you've got the equities. Equities is essentially the stock market, and it tends to have the highest overall average return, but then it's also the most volatile. Then you've got cash equivalents, which are, you got CDs, you've got government issued securities, you've got euros, you've got commercial paper, essentially an unsecured debt from a company that is very stable and something you can count on. It just almost no upside, but it's stable. And then you've got the fixed income, which is your bonds and your annuities. You put in a certain amount of money, you get a certain amount back every year until it's paid off, and then you get your principal amount back. Now, it's probably the safest, with almost no upside. And then you have real estate. Real estate really falls into the alternative investment class, but which also in that group is you've got private equity, essentially investing in a business or a private business or private real estate offering, or so you got private equity, you've got art, commodities. I don't know a whole lot about those, and that's not the purpose of the talk, so we won't get into that. So as I think about the ideal investment, which one does any of these closely related to this, to correlate with this, or are there any that are better than better than others? And so as I think about that, of course I'm a real estate guy. I've done the equities, but I think that's a good place to look at. I mean, I'm a real estate guy, so of course that's a great place to look at, right? Okay, so in real estate, there's a lot, probably 100 different ways you can make a lot of money in real estate. You got single family, which could be direct lending, or it could be, a direct investment, an active investment where you are overseeing it. You're lending money to somebody that's doing it, or you're, doing a JV deal. You've got office space. Office space can do great at times, but over the last, it seems like it keeps taking a beating. Retail, some of the retail is doing great, and other retail is not doing so great. Dollar General, for example, had the best growth it's seen in years last year. And then you got the REITs, the hedge funds that are essentially buying a group of properties or a property. And then you got the industrial, heavy industrial, refineries, manufacturing facilities, things like that. And then multifamily. So, I feel like that real estate really kind of hits these, kind of the ideal investment. Why do I think it hits these? Hedge against inflation. When a lot of the inflation is based on, I'm not sure if the inflation is based on the real estate rising or the real estate rises because there's inflation, but the value of real estate stays pretty close with inflation. And if you go by the government's numbers, I think they say that there's a 2% inflation each year. And something else I looked at, I should have had the source here written for you, but it said that real estate on average appreciates at 4.17% per year for the last 20 years. That was the thing I was looking at. So, is that a good hedge against inflation? And this would probably hold true for the single family also, but there's a few reasons I like multifamily better. So is it a hedge against inflation? I think so. It keeps up with it. Are there tax benefits? Okay, so the depreciation that you get essentially to write off, roughly 3% of your investment each year as a deduction, even though you're making money on the property, you get the tax benefit of depreciation. And there's also a tax benefit. We normally do and a lot of multifamily people do accelerated depreciation, which essentially allows you to write off a lot of what you invested. Check with your accountant, but maybe you invest $100,000 into a deal, and then you get a tax write-off in that same year for maybe $70,000. So you invested, and that can offset some of your other income. So huge tax benefits to owning real estate. So even though it's growing in value, you're getting a write-off. Is there cash flow? And this isn't important to some people because some people have it in IRA, but there is cash flow from the operations of like a multifamily property. We typically give quarterly distributions to our investors. And so, yes, there's a cash flow component. Is there stability? Are people always going to need a place to live? I think so. I think there's a lot of stability into it. Some states that have kind of anti-landlord laws and anti-business laws, I would say they're not as stable from this perspective. But for the most part, I think multifamily is stable. Is it passive? Well, it can be if you want it to be. For a lot of people, it's passive. Some of our investors invest with us because they don't want to make any decisions with it. They just want to, get a report, once a quarter, and they're happy not to know anything else about it. So passive checks that box. Does it have competitive returns? Absolutely. I mean, you compare it to, fixed income, the bonds, annuities, the cash equivalents. I mean, it blows those out of the water typically. And you compare it to the stock market, we look for investments that will give that will deliver 15 to 20% average return to our investors each year over the life of the property. Now that comes from cash flow of the property, and then it also comes from the sale at the end, which is typically a 3 to 5 years, which a lot of people love that they don't have to go out and find a new investment every 2 or 3 or 6 months like they might have to do in a single family deal if they're doing flips or lending, private lending for flips. So this is kind of nice. You don't have to reallocate, reevaluate a new investment every few months. So competitive returns, absolutely. I would stack this up against any of the others. And is there an asymmetric risk and reward? Now, of course, when I say stack it up against the others, yes, there are some other deals that may offer better deals that are a whole lot riskier. With the asymmetric risk reward, a lot of times they say, if you want high return, then you're going to have high risk. If you want low return, then if you want low risk, then you're going to have low return, and you have to pick. Well, why can't you have both, right? Why not find something that has a likelihood of a high return, or it has a high return potential with a low risk potential? And so if it does well, you do really well. If it does poorly, you don't lose much, right? Instead of, we're either going to make a fortune or lose it all, or we're going to be really safe, but hopefully we keep up with inflation. So I think it checks that box, the asymmetric risk reward. Does something that does okay in a downturn or an expansion. In a downturn, it's interesting because, back in, you look at 2009, 2010, as, millions of people were facing foreclosure, really having some struggles. The rent rates stayed stable or increased slightly during that time. Why? People are losing their houses, being displaced. They've got to rent. That's their only option. During an expansion time, there's not enough places for people to live, so they have to rent. They're willing to pay more. The rents go up, and we adjust the rents accordingly. So really, I think multifamily checks all of these boxes. Now, to reiterate what I said earlier, there's always going to be risk in your investments, and it's up to you and your tax and legal counsel to help you evaluate and make the best decisions for you. So, okay, so I told Quest that I would talk about teams today and investing with teams and how we can move faster and do more and better deals with teams. So we'll talk about that a little bit. Okay, so some ways to invest in multifamily. Now that hopefully I've established that multifamily is a good option that you should consider for your portfolio or in your portfolio. And by the way, I would say you need some diversification. You want to look for some really great opportunities and do some diversification in your portfolio and among asset classes. But as you maybe consider multifamily, there's kind of three different ways to invest in multifamily. One would be do everything by yourself. You find the deal. You develop the relationships with brokers and sellers. You underevaluate it from a financial standpoint. Then you evaluate it from a build standpoint. Then you evaluate it from a tenant profile. How well has the property manager vetted the tenants, and what kind of criteria am I going to buy this and find out that only a small percentage of people are actually paying, even though it's full. And then can you raise all the money by yourself and do the deal all by yourself? Can you close it? Can you manage it once you do close it? And then can you add a value add, and can you dispose of it properly and make a profit? So, a lot of people, they want to get in multifamily and they're like, okay, I'm going to do this all by myself. I'm going to do all these, 10 different areas of expertise all by myself. And they read a book or two, sign up for a guru course, which I'm not against either of those. But there's a lot involved in you doing a large apartment complex all by yourself. There's a lot involved doing it with a team. But we've all heard that team stands for together, everyone achieves more. So the first way is do it all by yourself. Good luck. I tried that, and maybe you can do it. But for me, I tried this. I was beating my head against the wall. I already had a lot of experience in the single family. I already owned my own commercial buildings, office, retail. I owned that all by myself. And so I thought I could do multifamily all by myself. And after some time of, beating my head against the wall, trying to figure all this out, eventually I learned to do the second way. The second way of investing in multifamily is invest passively in other people's deals. Now, I think this is a great opportunity, whether you're just looking to grow your investment so you can have more and reach your goals faster, or if you are wanting to get into investing in multifamily yourself and be more of the active investor, the key principal, the general partner of an investment, by investing passively in other people's deals. When you're doing that and you're learning by watching, you're learning by doing, you're adding value to the kind of the leads in the deal, you can learn a lot doing that. So you can do everything by yourself. You can invest passively in other deals. And then you can team up to do deals. Active investor. You're wanting to find these deals yourself and kind of have a disproportionate share of the profits. Okay, so, well, and some of you are probably thinking like, why in the world would I team up? Why have 5 partners that I've got to share this profit with, and investors that I get to share this profit with, when I could just do it myself and get 100% of that? Why would I work with a team? Well, that's a good question, because it seems like 100% is more than 20%, right? Well, only partly. Okay, so if you are teaming up, and let's say that you can do 10 deals with a team, or you can do, where you're getting 20%, or you can do 1 deal, or really probably what's more likely is 0 deals. What's better, 100% of 1 or 20% of 10? well, you'd be way better off and a whole lot less stressed to do, to do 10 deals with a team than to do one deal by yourself. By the way, work on an apartment complex with, let's call it 200 units, is about the same amount of work as it's less work than doing like a small to medium apartment, let's call it 40 units. It's less work than that, and a little bit more work than doing like a single family flip. So, it's not like a proportionate amount of work for the reward. So why team up? Number one, you can work in your area of talent. You can do the parts that you love and you're good at, and you can leave the things you're terrible at or you just don't enjoy to somebody that they love that and they enjoy that. If you're terrible with evaluating financial documents and and trying to determine if trying to learn new term capex and net operating income and things like that, and that just all confuses you and you hate numbers, then why put yourself through the torture, right? I mean, I would say team up so you can work and do the thing that you love to do. If you hate doing part of the process, then you're probably not going to do it very well, and you're probably not going to do it very long. Secondly, why team up? There's a shorter learning curve. Instead of you having to learn 10 different ways of making this investment work, you learn one or two areas. And since you're working in your area of skill or talent, then there's a short learning curve. And if each person is doing that, your learning curve is very short. Next, you have more deal flow and better deal flow. You have more people looking at deals. You got more people talking to brokers, talking to sellers, negotiating deals, more eyeballs. And so you're going to see more deals and better deal flow. And then you're also going to be able to leverage the team's experience. Now, going back to investing in other people's deals. And this, I promise you, this is not a plug because I'm trying to get you to invest in our deals. We do a lot of deals. In fact, each one of these slides, I think some of them we just visited and we took a picture because we were evaluating it. But for the most part, these are properties that are our properties that we've owned or we currently own. But investing passively, and it's not so that I can attract you to invest in our deals. Now, do I want you to invest in our deals? Yes. I want you to go to Facebook and like us. I want you to go to our website, sign up, and get our free underwriting, multifamily underwriting template. I want you to stay in touch with us, but it's not so you can be an investor in our deal. It's so that you can get further down the road. Investing in other people's deals allows you to leverage your team's experience. If you've invested, you're teamed up with several people, then you can leverage their experience. Me and my team have done so many deals. Me and my team invested in this property here. Me and my team have done this. Even though you don't have all that experience, working with a team allows you to leverage their experience. And then maybe your background or your work, what you do as a 9-to-5 is, helps you evaluate better some component of this investing. You can use that and you can leverage your other teammates and they're part of that. Okay. So that's kind of why to team up, and I'll talk just a little bit about how to team up and how to find these team members. And if we were all together, I would tell you like stand up and stretch and all that. But hopefully this is like getting your mind thinking. And if not, I don't know, slap yourself or something like that to wake up. But hopefully this is helping. Okay, so here's how a syndication works. Syndication is the model that a lot of people use that are buying large apartment complexes, large investment properties to get the money together, to run it, and then to sell it, and then the profits are shared with the investors. Okay, so here's kind of how that works. Syndication is regulated, and syndication is just the term that means basically what all I said. It's SEC regulated. There's multiple investors for one investment. By the way, that's to differentiate from a fund. A fund raises money, and then they have the discretion to invest in whatever they want, whenever they want, however they want, and how much ever they want. When you do a syndication, it's for one specific property or one specific bundle of properties. You have multiple investors in one investment, sometimes 2 or 3 in a package. There's accountability, distributions, reports. Then there's typically a value add component to it. The rents are low, we're going to raise them. The property looks terrible, we're going to make it beautiful again. We do that value add, and then we sell the property, profits are shared. Typically a 3 to 5 year process. Okay, now hopefully you guys aren't drinking from a fire hose and kind of getting lost in all this. And hopefully you come up with some good questions, because I'll try to finish a little bit early, give you guys some time for questions, and get back to what you're doing. Okay, so how to select a team. Okay, by the way, this is us at some of our properties, and the one I'm most proud of is the one at the top left, where Ben is talking to our property manager, and we're looking at that awful looking wall. It looks like you can get injured on. Let me just take you back to the slide that shows you what that looks like now. Okay, so this is what the property looks like now. Used to be a terrible, ugly looking property with some burned units, and now it's a beautiful, beautiful place that's under contract to sell at the end of next month or the beginning of the beginning of June. Okay, so now here is how we find team members, and here's how we evaluate team members. And really, we try to use our core values as a driver of our daily decisions, not something we just put up on the wall and kind of forget about and dust it off, the plaque every now and then. This is something that we use every day, and it really is a daily discussion, with our team, talking about values as we're talking about people that we're working with and new people. So now you can come up with your own. These are our core values. We get this out of a book called Traction by Gino Wickman. He came up with something called EOS, which helps teams run and work together cohesively. Okay, so here's what we use to develop our teams. Our core values are team player. It just means open, honest, transparent. Humbly confident. That means no arrogance and no entitlement. Do what you say, which just means be realistic and be reliable. Fourth is do what is right for everyone involved. And fifth is continually growing, open to the idea we could learn something that would change our perspective. Now, we're human, not perfect, but it's something we strive for every day. And as we've developed these values over, I think we came up with these 3-4 years ago, it just made business run smoother. And as we move away from some people, we move towards some other people that do share our values, we've made more money, it's more fun, and things just get done faster. So those are our core values. I would say pick up the book if you're interested in building a team. Now, if you're interested in joining, just investing passively, I would say try to figure out a way to evaluate the people you're going to invest with. Do they share these core values? Do they get it? Do they want it? Do they have the capacity to execute? So anyway, those are our core values. So we would love to, I would love to, talk further with you guys, whether that's in, over the phone, text message, email, or maybe you connect with us on through social media or our website. I mentioned earlier, if you go to our website, something will pop up. It says, do you want to, receive our newsletter? If you'll fill that out, then we will send you our underwriting template to help you, if you have any interest in that. So there's mine and Ben's, and I didn't put Max's down, but Max is actually our guy that helps teams. We've had some people that says, hey, can you work with us? We're not guru. We don't have a guru course. We don't have a book to sell. We don't have a program to sell you. But if you're interested in being a more active investor, you can talk with Max and we can, help you learn more actively. If you want to invest with us passively, reach out to us. And I don't have anything to, like I say, to sell you right now, but, we'd love to stay in touch and, love to get to know you more. So Derek,
yeah,
that's my story.
You, Paul. I love it. So keep your screen up, keep it shared for now. So that way people can gather your information. I'm going to be going over. So I know you and I had some questions that you and I wanted to talk about, but you're getting a decent amount of questions here in the chat box. So I'm just going to dive right on into them. Is that okay? So
sure.
One of the first questions that popped up is, where are you and the Multifamily Geeks and stuff currently really looking for properties, right? When you're trying to do these syndications, what seems to be good markets for you guys?
I'm glad you asked that because I always mention it. I always try to mention it. Didn't do it today. So we look in business-friendly, landlord-friendly states. We stick to the South and the Southeast. So we are focused. I live about an hour north of Austin. We focus on the Texas Triangle, kind of that central Texas, and then we focus on a 4-hour drive of Atlanta, Georgia. So we've got some stuff in Alabama, Georgia, the Carolinas. So yeah, thanks for asking that question. We stick to those areas.
Now, do you guys have multiple projects that go on at the same time, or do you guys kind of focus on one and then now that it's up and running, boom, now you start to focus on the second one?
We always have multiple projects going. Another good question. We always have multiple projects going. We're always placing LOIs, a letter of intent. We've, I think in the first quarter, evaluated, I think 50 properties in the first quarter. And just in the last month, we've got to best and final on 2 properties and put an LOI on another one. So we're always working some, and you never know, maybe we go 6 months without getting anything, and then the next week we get 2 of them accepted at the same time. So, but yeah, we are always doing multiple properties.
I love that. So then if someone wants to work with the Multifamily Geeks, is there, and I know this will probably depend on per project, and the people that are asking this, my light shut off. The people that are asking this, you definitely want to make sure you reach out to Paul because he may have to answer it on an individual level. But if they want to do deals with you guys, do they have to be accredited? Is there a minimum amount to invest? Like those type of things?
Sure. So in the past, we've done 506B, which allows sophisticated or accredited investors to come in.
Okay.
Now, it's on a deal by deal basis. Now, and there's some stipulations for each one. If they are sophisticated but not accredited, we need a pre-existing relationship. We need to get to know the person, more than just, them liking a video on Facebook or something before we can even take the money. So investing passively, we can always take accredited investors. Sometimes we can take sophisticated investors, which I won't get into that. Unless you want to. If they want to bring a deal, like maybe they found a deal that they want to invest in, they think it's a deal, we'll be happy to kind of look at it, evaluate it, and see if we think there's something there.
I love it. So as we kind of keep going through some of these other things, I mean, you guys have been in business for so long and you've done a lot of different deals that have come up, and we've brought you on several times. And I like the way you educate individuals because you do it differently. A lot of multifamily people come and they say the same things over and over and over. So I love how you went through this. Do you guys still own specific groups out or specific properties out in Georgia, or do you refinance them and sell them?
We typically have a 3 to 5 year hold and then we sell it. We currently have, we have one in Branson, which falls outside our 4-hour drive of Atlanta, but we've got a property in Branson, Birmingham. We just sold one in Marietta, Georgia, north side of Georgia. We've got one in Warner Robins, basically Atlanta, one in south, kind of far south Atlanta, and then we've got one in Columbia, South Carolina. So yeah, we've got properties out there.
So I got one that I'm kind of curious on. It says, what is your override percentage? Now, when someone says this, I'm assuming maybe what is your rate of return? Is that what they're talking about? Or what is the override percentage?
Yeah, I think they're asking maybe what the profit split is.
Okay.
So typically how we do it, and it's on a deal basis, but typically what we do is there's a preferred return to the investors, a 7% preferred return before anything is split. Okay. Then once and that's average per year. So, let's say we hold something 5 years, the investor gets 35% before anything else is split. Then from there on after, it's a 70-30 split. 70% to the investor, 30% to Multifamily Geeks.
There we go.
Really, I like how it aligns our interest with theirs because, unlike a fund where fee, regardless of how it performs, we're really incentivized to make them a lot of money. And the more money we make for them, fantastic, because it means we're going to make a lot.
Absolutely. Everyone's happy when they're making money. Hey, guys, so I see some of your questions coming in. I'm purposely avoiding certain ones. Reach out to Paul directly. Understand that his phone number and email are right on the screen. Paul, you're actually a really easy guy to get a hold of, right? So I love it because, and that's part of the thing that you like to do. Is that's why you said if you're going with the 506B type of a credit or a syndication, then you need to have that relationship, which is what you guys are great with. So in some of the properties, as you own them long term, do you have management companies that you work with or that you maybe own yourself or something like that to help manage this stuff?
We don't self-manage any of our own properties, meaning we don't have our own property management. We use several different property management companies, and some of them along the way we were like, okay, we're not using them again, and this one here we want to use this one more and more. So over time, as we've been in the Atlanta market for a while, we've and in Central Texas, we give that all to third party property management.
That's good. I find that a lot of times when people do that, then it takes a lot off your plate. I mean, property management companies are great for leveraging your own time personally. So I love that aspect.
Right.
Before we kind of close things out, Paul, did you want to give any last minute statements? We're going to kind of bring everything to a close.
Yeah, I'll just say this, that, a lot of people are just, kind of fearful, like, what's going to happen, and let me wait till the right time, and I don't want to, lead you into something you shouldn't be in, or try to get you to go in at the wrong time. But, I don't know if there's, I would just say if you've been sitting on the sidelines for, several years and you're like, oh, I want to do it, I'm not sure, just start, just get started, start where you're at. We'll be cheering you on along the way, whether you work with us or you work with another group or you do it on your own. Cheer all these guys on. And Quest didn't ask me to put it in a plug for them, but Quest is, we've got a lot of our IRA money over at Quest, and I think they're the best. Maybe I'm biased, but if you don't have an IRA or if you don't have enough in an IRA, talk to some of the people over at Quest, and they didn't ask me to say that, but I wanted to say it anyway.
Oh, well, thank you, Paul. I do appreciate it. And Paul's right. If you guys have questions how to use your retirement account, quit letting it sit here. Understand that when your funds are sitting here at Quest, it sits like a rock. People like the Multifamily Geeks have aspects for you to reach out to them, build that relationship, and put your money to work. So if you have any questions about using your IRA, please let me know, right? I put my email down there. You guys have Paul's phone number and email right there on the screen. So that's really all I have. So I hope you guys enjoyed today's class. Paul, thanks for coming on. I know COVID, we're right at the near end, so hopefully we get to do something in person again soon. So
I can't wait.
I know. Awesome. Well, I'll see you around. So, Ben, make sure to reach out to Paul. Oh, what were you saying?
Oh, I just said thanks, everybody. Hope everybody has a great day.
Oh, yeah. All right. Bye, everybody.